To truly grasp the essence of smart money trading, one critical concept stands above all others. Understanding order blocks is paramount. They are the undeniable evidence of institutional activity in the market. These blocks reveal precisely where major market participants invested their significant capital. Once you decode their underlying logic, you'll gain unparalleled clarity in interpreting chart movements, moving beyond mere speculation. We'll delve into the foundational mechanics behind these zones, exploring how to locate them on your charts. You'll learn to dissect their structure, body, wicks, and edges, and apply the holy trinity of three essential validation tests. Our journey continues with an examination of all 6 block variations, including the single most potent type, alongside a powerful 3-question filter. This filter helps distinguish genuine order blocks from market noise, complemented by 5 crucial contextual elements to boost your trading odds. But first, let's address the fundamental question. What truly defines an order block beyond just its appearance as a candlestick pattern? To comprehend this, we must first grasp a significant challenge confronting every major financial institution. Be it a central bank, a hedge fund, or a primary dealer, they cannot simply execute an enormous buy or sell order instantaneously. The reason lies in market impact, a phenomenon where substantial orders cause the market to react unfavorably. Your own purchase pressure drives prices higher, while selling large volumes pushes them lower, resulting in poorer execution for bigger trades. So, what strategy do these institutions employ to mitigate this effect? They meticulously divide their positions. A single, massive parent order is fragmented into numerous smaller child orders, often numbering in the dozens or hundreds. These smaller, individual orders are then carefully introduced into the market over time, utilizing sophisticated algorithms and precise timing. This gradual, often covert approach is designed specifically to minimize any visible market signal that could betray their true intentions. Their execution strategy involves identifying and utilizing areas of maximum liquidity, ensuring their presence remains as inconspicuous as possible. To further obscure their actions, these institutions frequently employ various dealers and intermediaries, allowing them to absorb some of the associated risks. Observing this intricate process unfold on a trading chart reveals a distinct pattern of concentrated market activity. What emerges is a specific area where prices have consolidated, indicating sufficient liquidity was available for significant transactions to occur. Following this period of accumulation, a sudden and aggressive repricing event, or displacement, invariably takes place. Price then rapidly exits this zone, propelled by a fundamental shift in the underlying liquidity conditions that previously held it there. This distinct pattern, a visible cluster of activity followed by a sharp price movement, is precisely what we identify as an order block. It's crucial to understand that an order block is not merely a specific candlestick formation. Rather, it signifies a critical liquidity event within the market. Therefore, when analyzing these zones, prioritize the prevailing liquidity state and the actual order flow dynamics rather than solely relying on volume indicators. However, a much deeper and more perplexing question arises. Why does price so frequently revisit these exact same zones? This particular phenomenon is where the majority of conventional market explanations often prove to be utterly insufficient or fall apart completely. Perhaps you've encountered this scenario yourself. You meticulously identify and mark an order block on your chart. Price then retreats into your marked zone, prompting your trade entry. Occasionally, it bounces perfectly, but often it simply slices directly through. The key to distinguishing between these varied outcomes lies in comprehending the fundamental reasons why price ever revisits these specific regions. Indeed, there are three primary institutional drivers behind prices' recurring visits to these critical zones, offering a deeper understanding. The first compelling reason is what we term residual execution. Large market participants rarely manage to fill their entire desired position in a single transaction. They deliberately leave behind a trail of passive interest, such as limit orders, hidden liquidity, or iceberg orders, precisely where their initial accumulation occurred. Consequently, when price eventually retraces back to that original area, these pending orders are still patiently waiting to be filled, influencing its movement. Our second institutional factor is transient impact. The effects of significant market activity are not everlasting. The market inherently seeks equilibrium. Liquidity gradually replenishes, bid-ask spreads tighten, and market depth returns to normal levels after a major move, restoring balance. This natural process leads to price reverting towards areas that previously saw substantial trading volume and interest. It's simply market mechanics, not some mysterious force. Finally, the third critical element is dealer inventory. The market makers and dealers who initially absorbed the substantial order flow are left holding a specific inventory. Their objective is to offload or unwind this accumulated inventory at a more favorable price, ideally making a profit or minimizing loss. Therefore, these dealers possess a clear inherent incentive to facilitate prices' return to those zones where they can effectively manage their inventory position. However, there's a vital subtlety here that many traders frequently overlook in their technical analysis. Price doesn't revisit your meticulously marked order block because the market is somehow obligated to confirm your trade idea or owe you a fill. Instead, its return is driven by a confluence of liquidity factors and institutional incentives, like those residual orders or inventory management needs, making that path statistically probable. Therefore, mitigation isn't a guaranteed event or a mystical requirement. It's a calculated probability based on these underlying market forces. While you now grasp the underlying why behind price movements, theoretical understanding alone isn't enough. You must practically locate these crucial zones on your charts. Let's shift to a practical approach and outline the precise method for identifying these significant areas on your trading interface. The journey to pinpointing these zones begins not with a single candle, but by recognizing the overall momentum of the price action itself. Your first step involves seeking out displacement, a robust, forceful, and clear directional surge in price. This isn't a gentle price meander, but a decisive repricing, serving as the initial indicator that institutional activity might have occurred. Next, for step 2, you must trace the price action back to its very origin point. Pinpoint precisely where this powerful move was initiated. Focus on the foundational area, typically a period of consolidation or a brief pause immediately preceding the explosive displacement. For the third and final step, identify the very last candle that moved in the opposite direction before the primary move began. If you're looking for a bullish order block, this would be the last bearish candle, or the final down close, right before the impulsive upward surge. Conversely, for a bearish order block, you would locate the last bullish candle that appeared just prior to the significant downward impulse. That specific candle is your order block. These three clear, repeatable steps, displacement, tracing back, and identifying the last opposing candle, make the process straightforward. However, merely finding this candle is only the initial part of the process. The true expertise lies in knowing how to accurately interpret its components. So, having successfully located your order block, the critical question becomes, how do you effectively read and correctly delineate it on your chart? The candle's body, spanning from its open to its close, defines your primary zone, representing where sustained, balanced trading activity took place. Consider this the working area, a region where ample liquidity allowed both buying and selling to occur, closely aligning with where institutional orders were filled. While the body signifies balanced trading, the candle's wicks convey a distinct narrative representing brief market explorations. These wicks act as liquidity probes, indicating instances where the market briefly ventured into less liquid areas only to face rejection. To correctly delineate your order block, establish a clear framework for drawing its boundaries on the chart. The proximal edge, which is the side closest to the current market price, will serve as your designated entry zone. Conversely, the distal edge, encompassing the furthest point of the wick, defines your maximum risk boundary for the trade. Your stop-loss order should always be placed just beyond this distal boundary, acting as your ultimate safety net. If price moves past it, your initial market analysis for this setup is invalidated, and your thesis is proven wrong. Additionally, mark another crucial level, the mean threshold, located precisely at the 50% mark of the candle's body. This specific line functions as your critical discipline indicator, helping you manage your trade effectively. Should price penetrate deeply into your zone, breaching the 50% mean threshold, it suggests a stronger opposing liquidity than anticipated. Consider the concept of adverse selection. Deep price penetration often indicates you're not getting a favorable entry. Instead, it's a warning sign that more informed market participants might be acting against your position. Observing price respecting the area above the mean threshold is generally a positive indication, confirming your zone's validity. However, if repeated penetration occurs without an immediate displacement response, it's an early signal that the zone's strength is diminishing. The inaugural and foundational criterion for validating an order block is what we call displacement. Such repeated penetration, without an immediate strong response, often indicates that you are being outmaneuvered by better-informed market participants. While respecting the mean threshold remains a positive indicator, consistent breaches without displacement are an early warning of a zone's weakening. You might identify these zones, but how do you truly ascertain their authenticity and confirm they possess genuine institutional weight? This crucial validation comes through what we refer to as the Holy Trinity, a set of 3 distinct criteria. If all 3 of these conditions are met, your order block is backed by real institutional activity. Otherwise, you're merely trading based on hope, not solid market structure. The primary criterion for this validation is displacement, which, yes, is also the initial mechanism you used to locate the block. However, at this stage, we ask a more profound question. Was the displacement sufficiently robust? Did price not just move, but truly reprice the market, leaving aggressively without looking back? In terms of market microstructure, such a swift, forceful movement suggests either complete dominance by one side or a significant liquidity void, allowing rapid price progression without resistance. Regardless of the specific cause, this strong displacement signals that the zone under consideration was indeed meaningful, marking a pivotal shift in market balance. The second essential criterion is imbalance, which most traders will recognize as a fair value gap, or FVG. This visible gap between candles is more than just a chart inefficiency. It serves as a direct visual representation of thin liquidity in that area. Price moved so quickly through this region that very little two-sided trading occurred, making the fair value gap a clear receipt of this rapid movement. Essentially, the presence of a fair value gap provides tangible proof that the initial displacement was a real market event, not just random market noise. Our third vital criterion is a break of structure, BOS, or a market structure shift, a concept whose true importance is often underestimated. Conditional orders, including stop losses, limit orders, and pending orders, are known to cluster around obvious reference points like prior highs, lows, or round numbers. Further research from the New York Federal Reserve confirms this phenomenon, showing that stop orders indeed cluster just beyond key price levels. When these critical levels are breached, the triggered stops then intensify the market's directional movement, creating a powerful cascade effect. So, a market structure break isn't some mysterious occurrence. It's the precise point where dormant, conditional liquidity becomes actively engaged. This activation confirms a significant shift in order flow, indicating a true regime change in market dynamics. Therefore, the three pillars validating an order block are clear: initial price displacement, a resulting market imbalance, and a definitive structure break. These elements directly correspond to genuine institutional mechanics, such as repricing, liquidity discontinuity, and a fundamental shift in market behavior. It is crucial to remember these three criteria, as they will be indispensable when we later design our advanced trading filter. However, before we proceed, it is vital to understand that the market contains more than just the standard type of order block. In fact, there are actually 6 distinct variations, and one of these specific types holds more influence than all the others combined. This is truly where the insights become compelling, primarily because most traders are only familiar with a single, common kind of order block. While the standard one is widely recognized, comprehending all 6 different types will undoubtedly grant you a substantial competitive advantage. To quickly review the standard order block, a bullish example is the last bearish candle before an aggressive upward price surge. Conversely, a bearish standard order block is the final bullish candle preceding a sharp downward move, embodying an absorption to repricing sequence. You are undoubtedly familiar with this foundational concept, but now we introduce a different, often misunderstood element: the breaker block. In my assessment, this represents the most potent kind of block, frequently catching many traders off guard and on the wrong side of the market. The mitigation block forms when price movement falters and shifts direction, yet without the intense, rapid motion characteristic of a breaker. This block signifies more of a rebalancing process, where liquidity is replenished and market inventory normalizes, rather than a forceful directional change. Next, we have the rejection block, identified by prominent long wicks that appear at the very peaks or troughs of price swings. Price momentarily enters an area, triggers some pending orders, encounters strong opposing forces, and then sharply reverses its direction. Crucially, you define this particular block by measuring from the extreme points of these wicks, not from the candle body itself. Beyond these, there are 2 more specialized variations that are less commonly discussed, but equally important to understand. The first of these is the vacuum block, which is essentially a price gap created by significant volatility, often during market opens or major news releases. It represents a void in liquidity that the price frequently revisits to fill, acting like a magnet for future movement. The second is the propulsion block, which materializes when price re-enters a previously established order block, confirms its validity, and then powerfully moves away. This action serves as a strong confirmation, indicating a renewed wave of aggressive market flow after liquidity has been reaccumulated in that zone. These 6 distinct types each reveal a unique narrative about the underlying market dynamics within a specific price region. Your ability to correctly identify each type will profoundly transform your trading strategy, directly leading us to the powerful filter I mentioned earlier. This is the critical tool I promised at the outset, designed to help you discern which order blocks truly offer viable trading opportunities. Many traders overlook a key truth. Markets inherently gravitate towards areas where liquidity is concentrated, often where stop-loss orders are clustered. Sometimes what appears to be a legitimate order block is merely a deceptive lure, an inducement crafted to trap unsuspecting traders before the true market movement begins. Highs, lows, and round numbers inherently attract price, not through conspiracy, but because they concentrate liquidity for efficient execution of large orders. Indeed, sometimes a formation resembling an order block is nothing more than bait, an inducement strategically placed to ensnare traders right before the genuine market shift. Therefore, to navigate these potential pitfalls, I present three fundamental questions you must pose each time you pinpoint a possible order block. First, consider if genuine displacement occurred. Did price aggressively move away from this zone, or did it merely drift? A sluggish departure means no liquidity, discontinuity, implying your order block is likely just range-bound. Second, assess if the price action created a measurable imbalance, such as a fair value gap, signifying thin liquidity. If displacement happened without leaving an imbalance, the move was likely too balanced, diminishing the zone's strength. Third, did the structural break coincide with a probable liquidity cluster, like a prior high, low, or a round number with resting stop losses? A break without an obvious liquidity source likely lacks institutional backing. When all three of these critical questions are answered affirmatively, you have likely uncovered a genuine institutional footprint. This provides the confidence to trade such a setup. Conversely, if any answer is negative, what you're labeling an order block might merely be a convenient rectangle outlining random market noise. With this filter, you can now discern authentic order blocks. However, merely knowing if one is real constitutes only a fraction of the full trading equation. The crucial missing piece is understanding the correct market context, which ultimately distinguishes a merely good setup from a truly exceptional one. So, imagine you've successfully located a valid order block, one that has effectively passed our rigorous three-question filter. Still, before you execute, always scrutinize the broader context, because even a structurally valid order block can fail if market conditions are unsuitable. The first crucial contextual factor to consider is the concept of premium and discount pricing within the market. To identify these, take your current dealing range and split it precisely at the 50% level, with everything above being premium and below discount. The rule is clear. Buy bullish order blocks in discount zones and sell bearish ones in premium zones, thereby naturally optimizing your risk to reward. By adhering to this, you ensure your trades align with the market's inherent structure, providing a natural advantage rather than opposing it. Our second critical contextual element involves assessing the liquidity path surrounding the order block you've identified. Remember, price movements are rarely random. They are typically driven by the pursuit of existing order pools within the market. Therefore, a high-quality order block should be situated along a clear route from a recently swept low to an untouched high, or vice versa. Conversely, an isolated order block lacking any evident liquidity target nearby is unlikely to represent genuine institutional activity. The third vital factor to consider for any order block is its freshness, or how recently it has been interacted with by price. An order block that remains untouched, experiencing its very first interaction, possesses significantly greater strength and potential. Each subsequent return of price to a specific zone gradually depletes the resting orders and available liquidity within it. Consequently, the highest probability for a clean and decisive price reaction comes from an order block that is engaged for the first time. Moving on to the fourth factor, we must consider the specific session timing when the order block becomes active. Institutional flow and significant liquidity tend to be heaviest during the London and New York sessions, especially during their overlap. Order blocks that activate outside these prime trading hours exhibit a considerably lower chance of clean displacement or mitigation. Finally, the fifth crucial element is multi-timeframe alignment, adding another layer of confirmation to your analysis. When a higher timeframe order block, such as a daily or 4-hour, coincides with a lower timeframe block in the same price region, probabilities amplify. This convergence signifies multiple institutional perspectives confirming the same area, leading to the most reliable order block reactions. Order blocks found outside these primary trading hours demonstrate a significantly reduced likelihood of clean price movement or successful mitigation. The fifth crucial element involves multi-time frame alignment. When a daily or 4-hour order block aligns with a shorter time frame block in the same price region, the probability of success significantly increases. This convergence indicates that multiple institutional perspectives are confirming the same area, leading to the most precise and reliable order block reactions. These are the 5 critical context factors. When several of them coincide with a valid order block, it signals a high-conviction trading opportunity. You now grasp that an order block is far more than just a specific candle formation. It represents a direct indicator of true institutional trading activity. You are also familiar with the 6 distinct types of order blocks and understand their individual characteristics. Furthermore, you possess the 3-question filter, enabling you to effectively distinguish between genuinely actionable zones and mere market noise. And finally, you comprehend the various contextual elements that powerfully enhance the probability of your trades succeeding. As you begin to apply these insights, there are a few important considerations to bear in mind. Firstly, resist the urge to label every consolidation candle as an order block. Allow the filter to perform its function. Secondly, always remember that context holds greater importance than the block itself. Even a perfectly formed order block will likely fail if the surrounding market conditions are unfavorable. And thirdly, prioritize freshness in your analysis. Zones that are touched for the very first time typically yield the cleanest and most predictable reactions. This video has laid down the fundamental principles. In our next session, I will delve into specific order block trading strategies, outlining the highest probability setups, their execution, and real chart examples. To continue advancing your trading knowledge, ensure you subscribe and activate the notification bell. If you found this content valuable, consider saving it. You'll want to revisit it once your understanding deepens. Thank you for joining me, trade wisely, and I look forward to seeing you in the next video.